Welcome to Premium Cashflow Real Estate Investing Podcast with SK027. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, SK027, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, SK027. Welcome to Premium Cashflow Real Estate Investing Podcast with SK027. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, SK027, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, SK027.
Welcome to another edition of Premium Cashflow Podcast. Today we have Jay Tenenbaum with AZP Capital. Jay is one of a very talented investors, as I call it. And Jay has done multiple ventures wherein he's done rentals, fix and flips, notes. Boy, the story goes on and on. So I appreciate you taking time, Jay, to join the Premium Cashflow Podcast today. And I want to welcome you. You want to give a brief background, Jay, as to how you got started, where you at with your company now?
Sure. Good morning, and thanks for having me. So I started investing in real estate in 2013. I was a debt collection attorney for 20 years with my wife before that. So this would be starting investing in mortgage notes just became a different debt instrument. I tell people that I've been in debt all my life, just not personally, right?
Right.
And so I've bought almost 300 notes, properties in 25, 26 different states since then. Really the only experience I had investing in real estate was just buying my own personal residence up till then.
Right. And actually, it's very interesting there, Jay, that you bring in your experience of a debt collection, which actually is extremely valuable because, you kind of understand the life cycle of, when the bills are due, when it's, like dead late, and when it is really crossing those thresholds where, it's going to collection, and when you have to knock on the attorney, and then obviously it gets into, much default and, places into collection. So I think your experience of being a debt collection agent and, different strategies that go around and, sort of the negotiation that goes on is extremely valuable, actually. And I'm sure you found that experience was pretty much directly correlated to, what you would want to start investing or, recapturing your investments or dead money from your tenants, I guess. Would you agree?
Sure. When I first started out, people would have the conversation of, with my debt collection background, that I had an advantage with regards to getting into this business. And I'll tell people that, no, I appreciate the compliment, but that's not what I would agree with. I would suggest that everyone has a special skill, quality, experience, or expertise that makes investing, whatever that realm that you're going to do, you bring to the table that particular expertise or such. Mine just happens to be debt collection. For example, those who, this business does take a lot of the analytical component, right? Where you sit in front of a computer and analyze things for hours on end. And quite frankly, I'm not wired to do that. I envy those who can do that. If you sit me in front of a computer for 5 minutes, the ADD kicks in and I'm out the door, right? So that's someone else's skill set or experience or expertise that I envy, but that I don't have. Now, what I do have, certainly with the debt collection abilities, is when we buy mortgage notes, we started out buying occupied assets with the idea of keeping the borrowers in the homes. And yes, I can talk to borrowers in that realm and do very good with that, and create the rapport. It's not something I would suggest that you try at home.
No, absolutely. I think you're one of the go-getter guys that, hey, let me get on the phone, or let's go knock on doors and let's make deals happen. I think you're one of those optimistic go-getter guys who, just can't sit on the, on your computer and kind of like, that's just not your specialty, I guess.
I'm not wired for that. You're right. Absolutely.
Absolutely. So, Jay, with your experiences in notes, like, how do you go about, educate our listeners, like, how do you go about analyzing a note and understand, like, okay, is it a good investment, bad investment? Should we pass it, and things like that? Can you maybe tell us, like, what kind of, attributes you look for while you're evaluating the notes?
Certainly. So first of all, there's no such thing for the most part as a bad note, just buying it at a bad price. So what you really need to do is make sure that you don't have to overkill your diligence. You don't have to get, paralysis by analysis, but you have to be pretty systematic in what you're looking to accomplish, and develop your teams in your out-of-state markets. And past that, just have an understanding of be resourceful to know that you've got essentially 11 exits to exit out of a note with, right?
Wow.
And be available to say, I'm not going to be short-sighted or predisposed and say, I'm only going to look to exit out of this one exit. I want to be able to say, what happens if I want to exit out of 5 or 6 different ones? And you build the ROI calculators or ROI analysis to say, what does each exit look like? And as long as you can see a sizable, where you're in the black as far as the calculator spitting out the return, you should buy that asset. And instead of saying, if I can't buy it at 30 cents on the dollar, it's not worth it. Well, that's not necessarily true. It all depends on what the available exits are for you.
Exactly.
And if the returns can, you may find out that you may reach a ceiling where at X price, you can't generate a reasonableistic return in 7 or 8 of the available exits. So it's not a good buy at that price, right? But if they still turn out, you're buying something at 60, 70 cents on the dollar, which is a little high these days, but it still may turn out a profit, a return that you're looking for in those exit strategies, then why not buy it, right? And really the whole key is a lot of sellers out there are selling assets that they've never worked through. It's just kind of reselling it as a commodity, right? Trying to flip it, trying to wholesale it.
Sure.
And where we've been successful is we, like Star Trek, will take it where no one else has gone before. We actually take the asset, actually talk to the borrowers, actually work through it, actually foreclose if we have to, and actually create that essential value add such that you're creating a different outcome than what's gone on previous.
Sure. I think, absolutely. Actually, it's really nice that, you can buy these notes at discounted price. And further, I guess, as you said, that you work with the borrower and come up with, I guess, a payment plan, if that's the word, right? So you come up with a payment plan. And I think based on the discounted price that you would have bought your note at, I think your cash flow or the resultant cash flow as whatever the payment plan you came up with the borrower, I think that cash flow could be significant, I would imagine. And when you start to collect a group of these notes, I can certainly correlate that that cash flow must be very appealing, actually.
Yes, it can. Now let's be realistic. There are several asset classes to buy in. You buy what's called your lower value asset, where the property that is secured by is, let's say, around $50,000 or less. Or you're buying in a higher class asset where the asset's worth $75,000 to $150,000. Well, in the lower class value, right, you'll do really, really well. Your numerical returns will look extraordinary. But you're getting, say, $300 a month modification payments to where you're getting 3/4 of a grape. Now, if you're buying an asset if you're trying to modify an asset that's got, worth $75,000 to $100,000, your returns are going to be less, but you may be putting $800, $900 in your pocket. So you're getting what we call 1/4 of a watermelon. Right. So it's just about, and it's a question of diversity of risk and minimization of risk, et cetera, like that. But, at the end of the day, if I bought a note for, say, 20 grand and the guy offers me $400 a month, in 5 minutes I can make a decision that I'll do it because my returns are fine. Right.
Absolutely.
And that's how, and you're right. And in that kind of space, that you can do really well at, it is still a question of volume. You need a lot of those notes to create cash flow in the 4 to 5 figures, which we've done. I mean, I bought almost 300 assets.
Yep.
I know from a debt collection practice, I know what volume is about. I know how to manage volume. I like to manage volume.
Wow. And just a couple of few questions around it then, Jay. You said like having teams around it to support, any due diligence that goes with, when you're analyzing the notes. Can you maybe educate us, our listeners, as to like what elements you should look at in terms of like, okay, which teams you need around when you're like, let's say purchasing it, like whether it's analyzing the note or looking at the property that, hey, whether it's not really a board up or a vacant dead property. Like, can you maybe describe as to like what sort of like how your team goes by in terms of like what elements you need for looking at these notes?
Certainly. So understand that in this business, you can scale up pretty quickly by having the ability to outsource a lot of your vendors. Okay.
Sure. Mm-hmm.
So if I'm doing my diligence, like for example, I do some cursory diligence on the front end to make my indicative bid. But once my bid's accepted and I have those assets in a contract, then I go into what we call our paid diligence. And that is I can outsource my title reports. I can outsource my property tax and understanding if there's any delinquent taxes.
Right.
I can outsource but what's best is if, for example, what we do, we strive to buy occupied assets. I know other colleagues that will buy nothing but vacant assets because all they want to do is foreclose and turn them into rentals. Sure. I want to be able to talk to somebody. So being the fact that trying to verify whether a property, that note on the property is occupied or not is key to me. So I will either engage a property preservation company who will go out there and do a really thorough look-see, or your local realtor. Right, your realtors are key because not only are they establishing value for you, but they will verify the occupancy and the color of the neighborhood. And that's really who your team is built with. Now, if you end up taking the property back, then you add in your contractors and your property management people and vendors such as that.
Right. So now in this business now, Jay, that you're dealing with, delinquent borrowers, right? So for example, if someone is behind on their house payment and, has, gone deep down towards the foreclosure, I guess my fear or where I'm going with this, Jay, is that have you ever thought that, hey, this borrower who is, in such default, would they have any other issues or lots of other delinquencies that perhaps may jeopardize your investment? Can you maybe share as to how do you reconcile those type of fears and what elements we should be looking towards?
Certainly. This? So we specialize in buying first position notes. We don't buy seconds. Okay. Right. So obviously from the very beginning with the title reports, we can verify that our note is in first position. And the only animal of the jungle that can beat us up is the delinquent property taxes.
Sure.
Everybody else, all the other any mortgages, any liens, judgments, etc., are all junior to us. Right. And if we do decide that we have to foreclose, all that stuff underneath us gets wiped out. But I got to tell you that, a couple things come to mind. One is I only, for the most part, foreclose on borrowers who have given every opportunity to work something out with me, and if they really can't get past their own stuff, their own noise, then they get foreclosed on. Right? Number one. Number two, I also take the approach, unlike some other investor friends of mine, where let's say the guy's been delinquent for 3 years. Well, some investors say, "How dare you not pay your mortgage for 3 years?" To me, hey, you haven't defaulted yet on my watch. I give you that opportunity to make it right now. With a short time frame, but for the most part, I'm not going to really beat you up a whole lot over where you've been because you haven't defaulted on my watch yet, right? And situations can change. Situations can change for the better at the time I buy it. Situations can change for the better while I'm in the process of foreclosing. I've done plenty of deals where first phone call I made, the minute I bought it, I worked something out to where we resolved something short of the foreclosure sale.
Interesting.
It all depends on the timing sometimes.
Right. And I think it a lot has to do with market as well. Like, for example, in the 08, 09 era, there's just so much credit crisis and there's just so many problems going on that if someone really even wanted to refi or, do a decent purchase, there was no credit available for even a lot of good borrowers who were just getting chased out of the market. it was just like even the property appraisals at that time were not coming at the value you would want. And that was really actually a very difficult time during those days. And also then, Jay, you moved on to do fix and flips and done, a lot of like rentals as well. Can you maybe share your experiences around like how you evolved into like going into fix and flips in terms of like what sort of projects you have done?
Certainly. So in 2014, when I started buying my assets, notes primarily, through about middle of 17, the notes were available, and I mean, they're still available, but the pricing started to get a little higher.
Sure.
And as we're analyzing things that where the sellers are wanting a little bit more for their assets than could make financial sense, when I put them through our calculator, the returns just weren't there. And coincidentally, we started cultivating relationships with banks and other sources where we're actually starting to buy the property. So we basically sat down and said, well, instead of getting, trying to get beat up over trying to negotiate pricing that doesn't make sense on notes, here we're buying property. What's our exit? Well, our exit's still going to be the same core strength, the core value. We still want to generate cash flow. Right. So we were starting buying property. We were buying property with exits, fix and flips, rentals, seller finance, turnkey, and lease options. Now,
wow.
What I said was 3 out of those 4 exits are still generating cash flow, just the same as borrowing as a loan modification, correct?
Sure.
So, and really, what was driving the bus was our teams we built with our local realtors and contractors in our markets, which we narrowed down to primarily Ohio, Illinois, and as parts of Alabama.
Sure. Strong cash flowing markets.
Strong teams were built,
right.
High rental demands in those areas. But really, we were able to ascertain the color of the neighborhood with our local teams, meaning, okay, this property is going to be built, is next to an apartment building. It's not going to be a good flip. It'll be a good rental. Or vice versa, right?
Sure.
I've got an investor buyer who will buy this flip from you the minute you finish it. So out of buying about 40 plus properties in about a year and a half, we did 10 fix and flips, and we did the rest, all the other, and about 18 rentals, and a variety of lease finance, lease purchases, and seller finance. And that's kind of where we've been. Now, from there, we sat down at the end of last year and said, okay, we've done all 4. What works? What doesn't work? Well, fortunately, knock on wood, all worked. But we also found out that the rental side of it really became efficient. In our markets, there's such a high demand for rentals that we are getting multiple applications, getting stuff rented up in a couple hours, and really getting that higher echelon type of tenant.
Wow, really nice. So speaking of rentals then, Jay, like how much, like what value you're buying and how much you are like investing to fix up, like what describe me, like, like your typical project, like purchase price, how much you put into it, your financing, and like, how much would that rent for typically?
Sure. So we're buying things in the $50,000 to $110,000 range for the most part. In our Illinois market, let's say we're buying it for $80,000, we're getting rents $1,400, $1,400.
Wow.
In Alabama, we're probably closer to $50,000, $60,000 purchases. Our rents are $800-900.
I see.
Rehab, we've gone from buying things at 50 cents on the dollar and spending $20,000 in a rehab to buying things that are pretty much rent ready, where we're putting $1,000 worth of rehab in them because we're already going to be able to generate that $1,300-1,400 a month in cash flow.
Right. In other words, I think buying quality assets and reducing the time or the whole time and the renovation time it takes to get it rent ready. So try to, I guess, go towards your end product, which is your tenant, as fast as possible, I guess. Is
Correct.
that right?
Yes.
I think similar thing happened in our portfolio as well. Here in our Baltimore area where, we have predominantly all our portfolio here. That's exactly what happened to us, is that we went as quality, buying as quality assets as possible. And of course, still doing the full renovation, but just having that great area and those things enabled us to, fast track, finding our tenants, basically. That does play into it. And also then, Jay, you have done some joint ventures and some, brought some limited partners as well. Can you describe your experience as to how large those deals were, like how you structured it, and, what sort of investor appetite do you see currently in the marketplace for such things?
Certainly. And that's been an evolving process as well.
Sure.
So pretty much it starts out with, we've figured out that a long time ago that it's not a one size fits all. Really,
right.
You're having a conversation with a potential investor, and you really need to know what their goals and objectives are. You really need to know, what they're investing in now, what kind of returns they're generating now. Because, if you can meet or beat what they're doing now, then you've got a potential, opportunity, right?
Sure.
So we've done a variety of, joint ventures. Where we're splitting equity 50-50. We've done, we probably evolved more towards raising capital through debt, where the investor puts up the capital and is getting secured by the real estate in first or second position and generating a monthly check. And we found that it wasn't so much strategies that made sense for us versus the investor appetite. Investors saying, look, the savvier investor wants to say, hey, my money to be working for me has to stay working. It's one thing to say, I want to deploy it for 6 months, but if I can't find something else to put it in for another month or two, I've lost money. So we've come, so through our longer, since we're buying things and focusing more on rentals, we're looking at, say, 1 to 2 year type arrangements where we could place your money, provided a monthly check as a debt, as a loan, and now your money's working for you, and you don't have to worry about where it's going to be deployed chunk by chunk coming back. And it's not what works for us. We figured out that that's what works for them because their money keeps always working.
Sure. And you move from perhaps you cycle this similar funds from I guess deal A to deal B to deal C,
exactly. We knock on wood, we pride ourselves with terrific customer investor relations to where our investors come back to us and say, if we did a fix and flip, we pay off, they want it rolled over into something else. If they've come to us and says, hey, I have additional monies to invest, even though they're already invested with something else, I want to put it into something else. What else do you have? And it's a constant process of saying, I've got deals or I've got money to deploy. And it's just almost times hard for, challenge for me to say, I've got an investor who's got money to deploy. It's got to work for them. I got to find a home for it, right?
I know. It's a good problem to have.
It's a good problem to have.
It's a really good problem to have.
And I'm blessed. And it starts with the fact that we, pride ourselves in the relationships that we build with our investors and the opportunities that we can create for them.
I agree with you. I think there's just so many things you have to do right and maintain your integrity to come to that level. And before, marketplace or people recognize that, hey, these guys are really ethical and do everything transparently, that they want to do more business with you. And I think it's a great thing to have that, when the same investors are saying that, hey, keep my money, go from deal 1 to deal 2 to deal 3, right? That's a good problem to have.
Right. And even in the very beginning, I can show them, you've got a track record of 40 plus properties. You know what you're doing.
Sure. And actually at that price point also, I think the appetite or, more and more people can participate and say that, hey, this is something, something we can, it's palatable for our investments as well. And of course, as the price point gets higher, that's when, it starts to stretch out,
Even so, and I'll tell you, you hit on something very important. And like I said, we have structured our programs, if you want to call them that, to fit the investor ID. In fact, we've also been able to cater to the investor who says, hey, I may only have $20,000 or $30,000, right? And back in the day, if I was buying notes and I'm buying lower value assets, that probably wouldn't be enough because you wouldn't be able to invest in that lower value note space to where you would get a sufficient diversity of risk. It'd be really risky to buy that one asset for 20 grand that was worth $50,000 and only one asset. You want to diversify your risk. So what we've been able to do is we create debt opportunities either in first position or even second position. Your $20,000 could be supportive of in second position on the same property and make a good, a sufficient return where you're going to have a more challenge of finding where can I place 20 grand or 30 grand in an area that makes sense, right?
Interesting. And did you also say that, Jay, that sometimes in these deals you really don't have any debt like a traditional bank financing involved? It's all investor and your money that you guys are kind of like recycling that. Is there any debt component from banks?
In the note space, it's all private capital. There is no institutional money.
Okay.
When we started buying properties, we actually developed a strong relationship with a local hedge fund out here in Arizona that was financing our acquisitions. And then they evolved and said, hey, they came to us and said, we want to start throwing rehab money at you as well. And so we started doing some of our fix and flips on our own. In the beginning, when we would get the acquisition from them, when we determined which exit we were going to go towards, we would then went out and raise private capital to replace them, right? Then we started doing fix and flips just with their money because we had the ability to do that. And if we're still going to go long-term on the lease options, rentals, or seller finance, we brought in a joint venture partner. Now we're doing a little bit of both. We may buy the property with the acquisition hedge fund and then replace it with a JV partner, or find the JV partner in the beginning to raise the capital to do the purchase. It all depends on timing.
Sure. I think market has a lot to do with, what inventory is available and, so yeah, that makes sense. So, Jay, like what sort of like good advice you have seen over the years, or, you got many good advice, in your career so far as investing is concerned?
The advice that I would impart is several-fold. One is be resourceful, right? The markets will shift, and not necessarily, when you say market shifts, it's like, the market went down and I lost my assets. So the market shifts, right? When pricing of notes started going higher, we just evolved into something different, right? We were able to be resourceful and nimble enough to do that, right? So you want to be resourceful. You can't prejudge where you're going to go, and surround you. And in the beginning, you have to surround yourself with others that have done this before, because really to go out there and be the Lone Ranger, it's where you're going to get yourself in trouble.
Absolutely. And one thing I want to add there also is that being resourceful requires a lot of learning. Like as you shift and move into different places, I think the ability to network with people and learn different concepts, I think there's a bit of tangent to are involved as well. And I love that, as you said, that I always say this, that being resourceful sometimes is more important than, just the resources in general, so it's all about,
I would definitely agree with that. Yes.
Yeah. So it's all about like, hey, who, they can share that, okay, what to do, so it goes like, for example, in my world, I always go back. I never have an issue with finding, like contractors or different tradesmen and things like that, because one of my key over the years has been is that, hey, if I'm finding an electrician, he sure knows that who could be the framer who has done the framing next to him or before you, or he could be working right next to a great plumber,
Right.
So I have like continuously traversed that network, that like if I know somebody new, I want to know whom he knows, so that my network grows. And I guess over the years, it just so happened that, I never run out of people, and, I'm constantly giving references to my other investors and things like that in general. So,
and the only caveat to that is sometimes you kiss a few frogs trying to find the right
vendors. Yeah, that happens.
But it happens, right?
Yes,
it's the nature of the business.
That happens. And I think you come to a point where, you say that, hey, you start to see those telltale signs that, hey, someone's not responsive, or he's not like, diligent enough to do the work, and they somehow wait away. And, you come to a point where you say that, hey, you just have so much work that you really don't sometimes have time to deal with inefficient, or sometimes, like really scrupulous people that will just try to take advantage of you, and you kind of evolve and you move on. And I think you come to a stage where I think your team is like that solid, and you're not like, changing too many things.
Correct.
So good. Do you want to share with our listeners like how they can get in touch with you and your company and everything?
Certainly. So again, I'm with AZP Capital. Our website is www.azp Capital. That's in like Adam Zebra Paul capital.com. My email is jay@azpcapital.com, and my cell phone, which I dutifully answer, is 714-458-6317.
Awesome. Thank you, Jay. I appreciate all that, and I appreciate your expert advice today. It's been a pleasure having you, and I look forward to hearing from you and doing great things. Okay.
My pleasure. Thanks for having me.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest. Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.